Hi, everybody. I'm Chelsea McCready, Senior Director of Hospitality Analytics for the CoStar Group. What they've said all along here is true. You cannot see anything up here, so sorry about that. I wish I could see your faces. Thank you for being here. Thank you for being here in person. It's just so lovely to be back in a room with a bunch of like-minded people, and it's so great to be here. So I've got some slides on hospitality performance, the hotel performance over the past 18 months or so, and then where we're going. And we'll have some time for questions and answers at the end, so please do submit questions through the app. I'll be happy to take those at the end. So first, what is CoStar Group and who am I? So CoStar Group is a collection of brands mostly related to real estate. The CoStar platform is a commercial real estate data platform looking at office, hospitality, multifamily, industrial, retail, all different asset types for commercial real estate. And so we've got several brands here. The last one is STR. So STR was acquired by CoStar Group a couple of years ago, and earlier this year, the STR data was integrated into the CoStar platform. STR, if you're not familiar, collects hotel performance data directly from the hotels. About probably 80% or so of the hotels across the country participate with STR, so that's a pretty good sample size. So we've got a lot of really deep knowledge for what's happening in this space. I'm going to talk just very briefly about the economic climate. I know Aaron Ryan with Tourism Economics covered quite a bit of that yesterday and we're kicking you guys off. So just a few quick slides there, and then we'll get into the hotel key performance indicators. That's the majority of it. And we'll talk about the hotel development pipeline and the forecast, where we're going, and then transactions, which I've realized now is not the same way that you think of transactions. We think of transactions as the literal buying and selling of hotel buildings, which is very different than the transactions you're used to talking about behind the scenes. So we'll get to that at the end. So first, economic climate. The big thing here is that the income stayed above baseline thanks to unemployment benefits and stimulus funds and things like that. So it could have been much worse because compensation did drop last spring, and it kind of got back to normal around this fourth quarter of last year. But it could have been a lot worse than it was, and thankfully we were able to get some funds to keep income above baseline to help people out in a tough situation. So what are people doing with all of this extra cash? First of all, they're saving it like crazy at levels that we haven't seen in a very long time. And that savings rate is coming down, but it's still elevated. And then they're also spending it. So spending on goods bounced back from, it dropped, in April like everything did last year, but it bounced back within 2 months. So spending on goods kind of skyrocketed, which we know, right? Everybody was buying stuff online, everyone is at home and buying furniture for their house, and hey, we've been meaning to put a piece of art on that wall over there, let's finally do it, things like that. But services, spending on services didn't reach baseline until about a year later, so June of 2021. And this correlates with hotel performance, so we'll cover that in a minute. Accommodations was hit the hardest of any industry in the United States. Almost 7 million jobs were lost in accommodations. And that's 3 times as high as the next biggest loss in retail trade. So that's pretty significant. And leisure and hospitality employment is still down by about 10% compared to our baseline of February of 2020. Compared to the total non-farm employment, which is still down by about 3.5%. So the issue with the employment in leisure and hospitality is, at first, it was a demand issue. So in a hotel, for example, the occupancy didn't justify full staffing levels, so we didn't really need the staff at first. And then over the spring and summer of this year, we started to need the staff again. And they weren't there. They didn't necessarily want to come back, or they had found another position, or they said, well, you can only offer me work on the weekend, and that's not enough hours for me. So wages have started to rise, because if we're not able to give people enough hours, then they need to make more during the hours that they are there. So we saw wages go up in leisure and hospitality from about $17 at the beginning of this year to $19. So just 8 months, we've seen wages go up $2 an hour. Inflation has been a hot topic over the past several months, but I just want to draw your attention to the fact that recent inflation has been driven by an increase in the cost of goods, not necessarily of services. We've seen services kind of pick up a little bit, but it's mostly a correction from the costs that came down over the course of the pandemic at the beginning. And the inflation in the cost of goods has been closely tied to supply chain issues. So an example of this that I like to talk about is probably the longest story I'll tell up here, but the example I like to talk about with inflation is the used car market. So if you've read any articles at all over the past several months about inflation, you're seeing that used cars are driving the CPI up. So let's jump back to the spring of 2020, rental car companies. Rental car companies typically, they kind of sell off their whole inventory about once a year. So they buy all new vehicles and sell off all of the vehicles that they've had for about a year. So the spring of 2020 hits, nobody's going anywhere, and they're not making any money, so they sell off all their vehicles, but they don't buy new ones, right? So they're just kind of sitting with what they've got. They keep a very low level of inventory because they're not making enough cash to have all of those cars. So jump forward another year, and the used car dealerships are saying, okay, we're ready. We need your old rental vehicles. We need those because people want cars now. They want to be able to drive places. They don't necessarily want to fly yet. And the rental car companies are saying, we don't have any cars. We didn't buy any new cars last year, so we don't have any to sell you. So that's one of the supply chain issues that we're running into, is just these weird situations that, one cause over here impacts something crazy over here. So the price of the used cars went up because the supply was constrained because the rental car companies didn't buy their new cars in the spring of 2020. All that to say, the inflation issues seem to be pretty transitory, so I don't think it's going to be a long-term issue. All right, now let's jump into the hotel performance section. Normally, when we're looking at hotel performance, we look at year-over-year percent change, primarily in revenue per available room, RevPAR. The reason for that is because RevPAR, the level of RevPAR itself, is not a very intuitive metric. It's revenue per available room. It's kind of a combination of occupancy and ADR. You know what 80% occupancy means. You know that means about 80% of the rooms have been sold. You know what $100 ADR, average daily rate, means. It's about $100 for the cost of the room for the night. But $80 in revenue per available room doesn't really mean anything to people. So we look at the growth and the decline, and we kind of go from there. And it also, smooths out some seasonality if we do it that way too. But percent change over last year and this year are pretty much useless. I do this for a living. I look at these numbers all the time, and I don't know how to interpret that. So we're looking at things a little bit differently. So we're going back to basics and just starting from the bottom and saying, all right, we're building it back up again, looking at hotel occupancy. So this is occupancy by month. The lighter bars are last year. The darker bars are this year. The gray line is the 3-year average for that month prior to the pandemic. So that's kind of what normal occupancy we would expect normal occupancy to look like for that month and throughout the year. So typical seasonality, March through October is pretty steady with like a little bit of a bump in the summer. That's kind of the peak travel season. Seems to have been the case this year as well. Last year, we saw occupancy bottom out in April at 24%, and then it didn't exceed 50% until about a year later in March of 2021. And then this year we've seen occupancy climb month over month, coming to 70% occupancy in July, which is only a few points shy of that normal occupancy level that we would expect to see in July. But August and September dropped again. So that's in part due to the typical seasonality. You see that those gray bars kind of hover around there and they drop just a little bit. So some of that's typical seasonality, but also the impact of the Delta variant. So over the summer, we saw some really strong occupancy for pandemic times, we should say. So what drove that strong occupancy? It's the leisure traveler. So the leisure traveler is back and better than ever. I love this graph. I mean, everybody's talking about leisure. Everyone knows it's very much leisure-driven, the recovery so far. But I love this graph because it really hits it home. I mean, transient occupancy is higher than it's ever been before. But then group, on the other hand, is still struggling to recover. So group is anything with a block of 10 or more rooms, typically related to conventions and conferences, sometimes weddings and bus tours and things like that, but a lot of times it's gonna be the conferences and events like this. So that group is just barely starting to recover. It's trying really hard, but it's not quite there, and that's, of course, because attendees are a little bit hesitant to go to events, but also meeting planners are hesitant to plan events and be liable for any type of COVID situation that might happen. So I know this event is typically about twice the size in terms of attendance, and that's very consistent with what we're seeing across the industry right now with conventions and conferences. We're seeing that attendance is sitting at about 40 to 50% of the typical pre-pandemic attendance. So, but the transient demand, the leisure demand is very strong. This is the exact same data, but just showed differently so that we can look at the seasonality a little bit better. So the bars are the occupancy with transient on the bottom and group is on the top, and that's over the past 18 months or so. And then the diamonds show you the 3-year average for that segment prior to the pandemic. So again, looking at the seasonality and comparing to kind of what a normal level would be. The big takeaway here is that transient occupancy met or exceeded pre-pandemic levels every month from April through July of this year. So let's call that the release of pent-up leisure travel demand. Finally, people have said, all right, I'm vaccinated, kids are off of school for the summer, we are going somewhere. And you know, the other takeaway here, of course, is that the trailing group recovery is pretty much to blame for occupancy not reaching pre-pandemic levels yet. As you can see, for the rest of the year, we can pretty much expect that occupancy will decline to some extent, especially if group doesn't kind of come in to fill the gap a bit. Although there's a case to be made for strong holiday travel this year. So a lot of people didn't go visit their friends and family for the holidays last year. And so we could see a surprisingly strong holiday travel demand. One reliable leading indicator that we've been keeping an eye on for hotel occupancy has been travel sentiment. So Destination Analysts is a research company. It's based out of San Francisco, and starting in February of 2020, they did a survey every week or every 2 weeks of the American traveler and asked them how they're feeling about coronavirus, how they're feeling about traveling, how they're feeling about all kinds of things. So do you think COVID will get better or worse? Do you think, like, how concerned are you personally about contracting the virus? How are you feeling about your finances? Do you have travel planned? Did you have travel planned? Have you canceled trips? They'd ask a million questions. But the one that seems to correlate the most with hotel occupancy is excitement to travel. So they ask, imagine that a good friend or close family member asks you to take a weekend getaway with them sometime in the next month. Assume this is somewhere you want to go. How excited would you be to go on this trip? And on a scale from 0 to 10, the share of people that said 6 or higher correlates very, very closely with hotel occupancy as a leading indicator. So the answers this month predict what's going to happen next month. So this question correctly predicted that we would see a decline in occupancy from August to September, and it's predicting that we're going to see a slightly higher occupancy in October, but not by much. So that's pretty much in line with what STR and CoStar and Tourism Economics are predicting for October as well. So we'll see if that plays out. One weakness of this this measure of the leading indicator is that it doesn't take group demand into account. So group demand accounted for about 25% of total room demand across the country prior to the pandemic. So once that starts to come back, we might see some higher occupancy numbers than what this indicates, hopefully. So the lack of group and business travel, it also shows up in our class data. We're looking at hotels from luxury down to economy, and the luxury and upper upscale properties are still seeing softer occupancy numbers than the rest, and that's been consistent throughout the pandemic. All right, switching gears, I'm going to turn our attention to average daily rate. Average daily rate has admittedly caught us by surprise. Typically what happens with rates is that they come back, they recover slower than occupancy. So we see occupancy recover, and then hotels have pricing power, and they drive rate higher, and rate recovers. And this one's been different. So we've seen some very strong ADR over the past several months, surprisingly strong ADR. But in general, big picture, the trends here for ADR look pretty similar to occupancy. Bottomed out last spring, kind of faltered through the rest of last year, and then started that month-over-month growth for this year, peaking in July. And once again, it's the leisure traveler that's driven these trends in rate as well. So weekend rates have reached the highest levels ever. Weekday rates is the lighter line here. They're actually somewhat normal, which surprised me at first. And then I realized that hotel revenue managers are very sharp, and they've figured out that discounting hotel room rates is not inducing demand in this environment. So they've said, these are our weekday rates, they are what they are, and they'll take whatever business comes their way. And then the weekend rates have been driven higher by that compression and the higher level of demand. The segment, the class that is seeing the highest rate premium is luxury. So it's, again, we're seeing that lack of price sensitivity on the part of the traveler. So a hotel RevPAR, revenue per available room, it's a combination essentially of occupancy and ADR. So it's not surprising to see very, very similar trends to what we just saw with occupancy and ADR. We've seen significant growth in RevPAR so far this year, $35 in January, up to $100 in July. We actually exceeded pre-pandemic July for just a moment there, and then it dropped back down below pre-pandemic levels in August and September. So here I'm going to take the baseline and set it to 0. So instead of having those gray bars or gray lines, we're going to smooth that out, set it to 0, and we'll show how close we are with each metric getting back to baseline. So with occupancy, we've seen a general upward trend after bottoming out last spring, with a dip in the fourth quarter, and then another dip in the third quarter of this year, corresponding with the COVID waves, of course. And then ADR, in general, the declines have been less severe than the occupancy declines. So we exceeded baseline in July, August, and September, like we discussed. They're higher than normal rates in July, August, and September. And then that brings us to RevPAR. So it's the same general trend, but since July, we're seeing this interesting dynamic happen where RevPAR is being pulled in opposite directions. So in July, the higher than normal ADR was able to pull RevPAR up above baseline, and then in August and September, we saw occupancy pull it back down. But at least we're seeing that tension now instead of both of the metrics pulling occupancy down at one time. So one thing that I want to make sure, if you don't remember anything else, remember that this is the most uneven recovery that we've ever seen in the hospitality industry. The recovery trends are very inconsistent across markets. So what we're looking at here is the year-to-date RevPAR for 2021 and comparing it to the year-to-date RevPAR in 2019. So normally we compare year over year, but that would be pretty much useless. We're just going to cut out 2020 altogether and just say, all right, let's compare to the peak year of 2019. The markets that have beat or come close to 2019 RevPAR levels are pretty much coastal. So Myrtle Beach, Virginia Beach, Miami, here we are, and Tampa. The US average is still down by about 24%, and most large markets are down by more than that. And then the markets that are struggling the most are markets that are highly reliant on groups, but also international travelers and those markets that have had more stringent coronavirus-related restrictions. So the more barriers you put in place, the more hoops that you make people jump through in order to enjoy your destination, the lower that your occupancy is going to be. And that's not to say anything bad about the cities that have put those restrictions in place. Everybody is making tough decisions about trying to do what's best for their residents, of course, but it does have an impact on hotel performance in markets such as San Francisco and Boston and DC and New York. This is the list of same markets in the same order. We're just looking at the stacked occupancy and ADR declines from year-to-date 2019. So all markets are still trailing in occupancy, so nobody has quite reached 2019 occupancy levels yet. A handful are seeing stronger than normal rates, so that's what's pulling those markets up to the top there. For the US average, the occupancy is holding back that recovery more than rate is. But that's not true in all markets, so there are a couple of markets where rate is actually holding back the recovery more than occupancy is. But there's just a few of those. Austin is one and Atlanta is another. There's a few more. But I think it's interesting because the reason that rate is holding back those markets is primarily due to large events that drive rate really high. And we're comparing against a year where those rates were really high due to those events. So for Austin, it's South by Southwest. That drives rates really high in March. But we obviously didn't have South by Southwest last year or this year, so that's why rates are down a little bit lower. And in Atlanta, that was the Super Bowl. So they had the Super Bowl in 2019, and they did not have the Super Bowl this year. So I think that's an interesting way to look at which markets are doing well and what's driving it. All right, moving on to the hotel development pipeline. This is the number of rooms that have opened or are scheduled to open by year, by phase of the development pipeline. So this year we are expecting to see the highest number of rooms open in one year in recent history. We've got 87,000 rooms that have already opened and 46,000 rooms that are currently under construction and are scheduled to open by the end of the year. Of course, construction timelines do not always go according to plan, so some of those will get pushed into next year, undoubtedly. But the big thing here is that the wave of new supply seems to be cresting, and then we are going to see a decline in the number of new rooms opening by year going forward. And that's consistent with what's happened after previous recessions as well. So we like to look at the number of rooms under construction as a share of existing supply or of inventory to understand what the impact of that new supply is going to be on the different markets. So nationally, the share of rooms under construction is about 3% of existing inventory. The larger markets, it's a little bit higher, about 4.3% or so. And then on the high end, we've got an outlier for sure in New York City with about 14%, Nashville about 10%, Miami, here we are with 8%. And then on the low end, we've got San Diego and Oahu. And these markets generally have barriers to entry. Either the cost is just you can't do it. The cost is too high to build in these places, or there's restrictions in place about new development. This was a hot topic this time last year, and I don't hear many people talking about it anymore, but it's the temporary hotel closures. So last year, we had about 15% of hotel rooms across the country temporarily close their doors due to the pandemic. They just said, it doesn't make sense for us to even be open, let's just shut it down, and we'll open up when there's travel demand again. Now, only about 1.4% of rooms are temporarily closed. And those rooms are mostly in 3 markets. So that's New York City, which coincidentally has about 14% of their rooms temporarily closed. So 14% of rooms under construction, 14% of rooms temporarily closed. That's a coincidence, but that's a funny coincidence. And then San Francisco and Orlando both have, I think, about 8% of their rooms temporarily closed still. We do expect most of those to eventually reopen, but also the level of permanent closures that we've seen this year is below average, so we think that this temporary closure has kind of hidden the permanent closures, and they're just kind of putting off that decision until, and whenever they want to make it. All right, let's look at the forecast. Big picture, RevPAR was growing for a decade prior to the pandemic, so we were in an expansionary period for about a decade. And we do expect a pretty rapid recovery compared to other downturns, like after 9/11 and the financial crisis. But let's look a little bit closer and see what this looks like. So here we've indexed 4 primary metrics to 2019. This is the country's peak year, so keep that in mind as we're going through, that this is when we expect to get back to peak level for each of these metrics. So RevPAR is expected to exceed 2019 levels in 2024. But it's only a couple points shy of 2019 levels in 2023. So that's pretty much back to normal by that point. So let's look at what's driving that recovery timeline. Demand is the number of rooms sold. We expect demand to return to 2019 levels in 2022, as soon as next year. So the reason for that is that once people feel safe to travel, once event planners feel safe to host events, people get out and people host events and people travel. So assuming that things continue along with the mitigation strategies for COVID-19, we don't see another variant that derails us, then we expect to see demand return in full force in 2022. But occupancy, the recovery with occupancy is going to be a little bit slower because of all the new supply we just talked about. So it's just going to take time to absorb all of those new rooms. Like I said, that wave of new supply is cresting, and couldn't have come at a worse time to try to absorb all of those new rooms, but that's where we stand now. So it's just going to take a little longer. Occupancy is set to fully recover in about 2024 as well. And then ADR is interesting. Like I mentioned before, ADR typically recovers slower than occupancy, but this time the ADR recovery has outpaced the occupancy recovery. We do expect that to moderate, and then we expect them to kind of move together going from here. And the reason we expect the ADR growth to moderate is because once that group demand comes back, the group rates tend to be a little bit lower, so it's going to pull that growth down just a little bit. We're going to see a deceleration in the growth. It's still going to continue, still going to get better, but it's going to be a little slower. So, but the market level recovery is going to vary widely. So I picked 3 markets here just to show. Miami is a very interesting case study. So we're expecting to see pretty much a V-shaped recovery in Miami, where we're back to 2019 levels by the end of this year. And then you see it goes up in 22, and then it kind of softens a little bit in 23. So I've gotten some questions about, why do you expect that? Why wouldn't it just keep growing? So the reason for that is that US residents generally haven't been traveling internationally. So instead of traveling internationally over the past, well, I guess this year and probably into next year as well, they've picked domestic trips, and they've substituted places like Miami instead of taking those international trips. So once people are easily able to travel internationally again, we think they'll go back international, and we'll see some numbers in Miami come back down just a bit. LA is another one on here. They're expected to reach 2019 RevPAR levels not until 2025. And then New York City doesn't even reach 2019 levels by 2025. We don't currently have a forecast for when they're going to reach 2019 levels. And that's primarily due to all the new supply that's coming online, with that 14% of existing supply under construction. It's just a lot of supply to absorb during this time frame. All right, last section, transactions. This is the literal buying and selling of hotel buildings. So hotel sales volume, and sorry about this, didn't realize there was an animation on this slide. Hotel sales volume has bounced back this year after falling significantly last year, but it didn't drop last year as much as it did during the financial crisis. So I think that's interesting. When we look at this quarterly, it's a little bit easier to see how quickly it bounced back. So it did drop down to the same level as the financial crisis in one quarter, and then it started to bounce back very quickly after that. The second and third quarters of this year actually saw nearly the highest levels of transaction volume in recent history, which is indicative of the strong investment appetite and outlook that the investors have for the hospitality industry. We've seen some distressed sales in the hospitality space, but it hasn't been nearly as much as we expected to see and as much as was talked about at first, given the level of impact that the pandemic has had on the hospitality industry. So the transaction volume in the second and third quarter was boosted primarily by large portfolio sales and acquisitions. For instance, Blackstone and Starwood Capital acquired Extended Stay America, and they're like 570 hotel properties or something in the second quarter, so that helped bring it back up. And then there's also been several high-profile luxury trades priced at over $1 million per key that have happened just in the past several months. So just a few of those high-profile luxury trades are listed here. I'm not going to read them all off, but these all exceeded $1 million per key. So a normal kind of run-of-the-mill, I'm not going to name any names, upscale hotel would be somewhere around $100,000, $200,000 per key, something like that. So to see $1 million per key is pretty impressive. Host Hotels and Resorts bought Four Seasons Orlando for $1.4 million per key. Hyatt bought Ventana Big Sur for $2.5 million per key. So there's a lot of confidence in the investor space in the resilience of luxury travel. This is the transaction volume by a different property type. So one of the benefits of being part of CoStar is that we have a lot of across asset type data that we can compare. And the other property types dwarf hotels in the capital markets. But it's interesting to look at the trends, while we're here. So multifamily and industrial are both growing like crazy. There's a lot of transactions happening in those spaces. Retail and hospitality are kind of back to normal after the pandemic, pretty much kind of flat. And then the office is not quite back to typical levels yet. And that's due to all the uncertainty around hybrid working and remote working and things like that. Are office-using companies, historically office-using companies, going to continue to use office space going forward? The other property types didn't quite take a hit to prices like hotels did during the pandemic. And part of the reason that the price for hotels fell is because the types of properties that sold shifted to those smaller, limited service, economy type properties. So it wasn't necessarily that they slashed the price of the property because it was a distressed sale. It's just that there were more properties being sold that were on the lower end of the spectrum than the higher end. But we started to see that turn around with some of the high-profile luxury transactions. And hotel is now moving in the right direction. And it is still above office and retail when indexed to the trough of the financial crisis. So hospitality is still seen as a very good investment. Hotel cap rates have remained relatively flat, which is surprising, right? Cap rates, they capture the level of risk, essentially. So it's surprising that they've remained relatively flat to me, given the level of risk associated with hospitality properties that the coronavirus kind of laid bare. But it is forecasted to remain flat going forward as well. So Got some key themes here for you, but I've already said most of this stuff, and I don't really want to repeat myself. I'm sure we'll get these slides out to you, so I'm going to leave it at that, and then I'm going to start on questions. All right, I've got a question here. Okay, hotel occupancy in prior recessions recovered several years before ADR. This summer, ADR was above pre-COVID levels. How sustainable is that trend in 2022? I don't know that it is fully sustainable. I think we're going to see rates, stay below pre-pandemic levels throughout the fall and winter, most likely, probably a little bit into the spring. They might come back up in the summer again, especially if it's very leisure-driven again next summer. But as we see groups start to come back, that ADR is going to moderate just a little bit. All right, while it makes sense that companies will resume business travel, aren't most companies and employees eager to reduce the frequency? I would agree with that to some extent. I think the area where we'll see the companies reduce business travel is the internal business travel. I think they've probably decided, like, all right, everybody that's in this, that would be in this meeting together knows each other already. Then we can just do this over Zoom, and it's so much easier and more cost effective. But with sales and talking to clients, I just don't know that people are going to be willing to forego those types of trips. So I think we're going to see a divergence in the types of business trips that are taken. Any insight into national parks demand? It was very high last summer. Any indications it will be as in demand in 2022? I'm a huge fan of the national parks. I love taking national parks trips, and I hope that over this past year it's opened people's eyes to the glory of the parks and that the demand for that will continue. But honestly, I don't have any specific indications about, or leading indicators as to what that will do. But it does seem to be more on the forefront of people's minds. And until COVID is more and more resolved, people are going to feel more comfortable doing things outside and that kind of activity. So I think it's safe to say it's still going to be strong in 22. And I hope that continues going forward because they really are just lovely destinations. If anybody wants to talk national parks afterwards, I would love to do that. Previous recessions were linked to market corrections. This one was linked to a pandemic. Any suggestion we might see another one related to normal cycles? That's a great question. So this question, I guess, assumes that we're going to see recessions for normal reasons. And I think that's a reasonable assumption in the United States. But it is one that we probably need to question to some extent because, like, for instance, Australia, before the pandemic, hadn't had a recession in almost 30 years. So if the economy is functioning in a way that's healthy and well-regulated and things aren't too good to be true, like the mortgage crisis, subprime mortgage crisis, things like that, the economy can continue to grow. And we saw that for a decade leading up to the pandemic too. We had a pretty long expansionary period before the pandemic. So in terms of predicting recessions, I'm not going to pretend to have an answer for you, but if something seems too good to be true, it probably is, right? That's something that I've noticed over the course of my economic training, but what that might be, that's hard. I mean, economists, I used to be able to say, I'm not an economist, I don't know, or technically I'm an economist now, and all that's taught me is that economists just don't really know anything more than the rest of us. They could just keep track of certain indicators, and if there isn't an indicator for something that's an issue, an underlying issue, they're not looking at it and they're not going to catch it. So no, they're not really smarter than anybody else. But at the end of the day, if something's too good to be true, it probably is, and that would be my leading indicator for a recession. However, a stock market correction, that's a whole other thing. The stock market has not indicated that we had any kind of pandemic whatsoever. So there's some kind of correction coming with that, undoubtedly, at some point over the next probably 12 months or so. Are other lodging types seeing a similar performance, hostels or vacation rentals? So that's a great question. I don't have vacation rental or Airbnb data or short-term rental data or hostel data, but the little that I do know about that sector is that it has done very, very well. So, and part of the reason for that is because it caters to the leisure traveler, which, as we saw, is back and better than ever. So yes, they've seen some very, very strong performance, unseasonably strong performance over the past year, and especially in the summers, even better than they normally do. But I don't have any specific data for you on that. All right, what is the impact of international inbound travel to occupancy and rates? That's a great question. International travel, people spend at much higher levels when they come from out of the country compared to domestic travelers. They just spend more while they're here, they stay longer, so they have a very, very positive impact on occupancy and ADR, especially in those major gateway cities. New York City is definitely struggling without the international visitors. I think almost half of their visitation, overnight visitation, is international typically. So that's another reason that the New York market is struggling so much. Miami is an interesting case because Miami also historically has a very high reliance on international visitors. But again, like we talked about, they were able to kind of substitute the high-end domestic traveler for those international travelers. All right. Are we expecting disposable income to be high in 2022? Will those traveling spend more? I think we've seen that people need to travel, and I don't just say that as somebody that's in the industry, but as somebody that's looking at what happened this past summer and saying, wow, all right, people really want to get out there, and there is a level of price insensitivity. In terms of disposable income being higher in 2022, I can't speak to that, but I do know that they've been saving at higher rates, so I can imagine that they probably have more money in the bank to spend. So most likely is my answer to that one. Let's see, do you expect a negative impact as the international leisure travel restarts? The US has traditionally been a net exporter of tourism. Let's see, this is a complicated one. So the border reopening process has been so messy and there are so many hoops to jump through that until that becomes clearer and easier, I see a lot of people staying put for now. One of my colleagues just went to Ibiza for a week. I'm jealous, right? And he said he had to put together different paperwork to get from one place to DC, another set of paperwork and all this for DC to, I think it was Berlin, and then another set of paperwork from Berlin to Spain. And he said it was just a nightmare. And most people are not going to be willing to do that. So I think until that starts to, until that's just cleared up to some extent, we're probably going to continue to see the trends that we're seeing right now, where it's mostly domestic travelers staying here and mostly international travelers staying where they are. But it'll return to normal levels once it becomes a little bit easier on both sides. Is CoStar collecting data on glamping, RV camp style lodging? Any data you can share with that? Unfortunately not. So we stick to hotels right now. I think ideally, yes, we would like to expand that eventually, but we do not have that data now. I did see the transaction related to an RV park in, I think it was in Texas, that happened several months back. And they sold their RV park for, I want to say it was 4 times the price that they bought it for several years before that. So I think that sector is doing very, very well also. But I don't have any hard data for you on that. And that's all the time I have right now. Thank you so much for having me. I hope this was insightful, and thank you for being here. And I don't want to stand in the way of you and the afternoon drink of your choice.